So my name is Jeff Graveson. I'm a founding partner with Toro Furioso Consultants,
And I'm Zen Zhang, the other founding member.
and we're going to talk a little bit today about our portfolio. All right, so the goal for our portfolio was to invest $100,000. We did this with 12 equally weighted assets, meaning that they were each allocated the same amount, same portion of the funds. These assets included 10 ETFs and 2 equities. Our 2 commodities assets were both US and Chinese basic materials. Our 2 currency ETFs were in the Chinese renminbi and the Japanese yen. We also had 2 aerospace assets, a real estate asset, a global market asset in ex-US, shipping, bonds, energy, and finally an equity in the cannabis industry. So as a whole, our portfolio beta was 0.07. That was in keeping with the beta neutral target that we had when we started the portfolio. We used the SPY as our proxy for the market rate. And calculated that beta using 12 monthly returns from the end of November 2017 through the end of November 2018. So here we have some benchmarks for the performance of our portfolio. We have the SPY, which was our proxy for the market rate of return, and SHY, which was our proxy for the risk-free rate. The goal of the hedged portfolio, the beta neutral portfolio, is to return something slightly better than the risk-free rate while taking on a minimum amount of risk to do so. So even though we beat the SPY technically by not losing quite as much, we'd like to see that risk even lower. So we'd like to see a rate of return much closer to the risk-free rate there while also taking on less risk. So here we have a look at our long positions for the portfolio. We split our 12 assets up into 6 longs and 6 shorts. Here we have our 6 longs. This made up the majority of the loss of the portfolio. We really took a hit on these long positions. Most of that was due to the steep decline in the DFEN. So this was an aerospace ETF. It was designed to return 3 times the rate of growth in the aerospace defense industry, and it also had a beta of 3.24 when compared to the SPY. So this was a pretty risky investment, and unfortunately it didn't turn out well for us.
And so, like Jeff said, our longs took quite a hammering, but our shorts actually covered quite a bit of that, riding the overall downturn in the market. Our materials, aerospace equity, ex-US, and global shipping ETF all brought in more than anticipated based on their beta values. And overall, we had a gain of $3,683.30. In our batting averages in our longs, 2 of our trades beat the SPY and SHY. In our shorts, 4 beat both. And then in our pairs, 3 beat the SPY and only 2 beat the SHY. And so that leaves us overall with a batting average of 50%.
So we did try some pairs trading in the portfolio. In total, we had 4 trading pairs. And then this chart also shows our risk-free rate of return and the market risk rate of return. So you can see that we took a pretty big hit on this one pair, the I Want a New Drug play. That pair included that defense industry ETF that we noted we took a hit on in the long section. You can also see that we returned modest rate on our macro market play as well as our sector play, but not nearly enough to offset the hit that we took on that defense industry I Want a New Drug play.
And so we wanted to dig in a little bit more to get to know what was actually going on. And of course, we're going to start with this portfolio defining pair of DFEN and UTC. So when we were originally planning this, we were thinking that as contractors of the government, they would be less exposed to global uncertainty. That was totally not the case. They very much track the market, and they both tracked it down. Not only that, but they were both pretty correlated in terms of how they track the market. And so when one went down, the other went down as well. And so what we really should have done is actually maybe diversified our risk within the situation. You know, we have the sector ETF, the defense, and then we have the individual stock. And so we actually maybe should have positioned ourselves where we diversified the risks the exposures that we were putting ourselves into. So if there's one thing we learned in this experience is that pairing is great. It exposes us to different things and helps to hedge our bets. And so we wanted to try and maybe match our single trades. So our first one, XOP, was an oil exploration trade. Pretty risky, but one thing we could have done was the Harvard Management Company trade, where we find something highly correlated and then try to get that difference. And so we did find one that's XES, which is Equipment and Services ETF, and we could have really capitalized on that. A second ETF is SEA, which also did quite well for us with an 11% return. Leverage that with maybe a pure stock play if we wanted to get aggressive. Maybe using the biggest shipping company in the world, Maersk, as the long. Next, we can see our expense report, and what we find is actually because we had capital losses, we actually have a tax credit at the end of over $3,000. So I guess that's a silver lining. So after 2.5 months, what we find is that our journey is just one of a classic hero, an up, a down, and redemption. And so we saw both markets, the tail end of a bull and then the downward spiral, and how it changes our portfolio overall. And we saw with the DFE, and again, the danger of a beta, the beauty of it in the beginning and the crushing defeat of it at the end. And also, of course, we've learned the necessity of pairing. It's so important, diversification. I mean, a market can be summed up in just one price, but really, there's so much going on. It's so complex and it's incredibly fascinating. Thank you.